Mr. Patterson, then Mr. Obernolte.
For the purpose of time and don't need to go back over old territory. But just briefly with respect to the LAO's analysis. Members, this is a very serious analysis. It is clear and in-depth and shows significant holes in the plan. And I really think we have to understand that, embrace it, and deal with it. So I'm not going to go over all of the concerns that were raised. But I think I heard two things here. One, you're $3 billion short of the initial segment. $2.9 billion?
Actually,
I thought I heard you testify to that.
Let me just be clear, Assembly Member. If we do not get that money, we can build a segment that operates without a subsidy and comports with the Bond Act. If we get that money, we have a better and more sensible segment. But the $3 billion is not necessary in order to have a useful segment under the definition of the Bond Act and useful for other purposes. It makes more sense to connect into Bakersfield and upgrade into San Francisco, but if we don't get that money, we will build something that comports with the Bond Act, delivers passengers without a subsidy.
Do you have a response?
I think the $2.9 billion that you're referencing is to extend the initial operating segment into Bakersfield, as well as certain upgrades to allow high-speed trains to get up the peninsula partway into San Francisco, not the full scope of San Jose to San Francisco.
Did I also hear that the terminus in Shafter could be there a decade or more? I understood that you had to get, if you got additional money, it would be through federal sources and it would be over a long period of time.
Federal sources are the first source that we're going to seek. If that doesn't happen, we'll be looking for other sources to make that connection because it makes sense. I think that going to the question that Assemblymember Gordon asked, and also the issue that was raised by the LAO, our current draft business plan contemplated, because that was, Shafter was the end of the construction, that we would put a temporary station there. We've heard a lot of commentary from people questioning whether that makes sense or whether the last station should be in Hanford, which is, or Wasco, which are our current stations. So we're looking at that question. If there were a temporary station, it would be there until we extended down into Bakersfield. We have people questioning whether the temporary station makes sense, and we're reevaluating that issue.
Did I misunderstand that the time frame with respect to finding additional money could stretch a decade or more to get to Bakersfield?
Well, that is correct, Assemblymember, in the sense that we're saying that this will open in 2025, which is 9 years from now, and we would like to be able to open to Bakersfield in that same time frame.
Second point, wasn't the decision to make the turn going south to going north a tacit admission you just couldn't build going south?
I think I said before, Assemblymember, that if we look at the dollars in hand, the federal dollars, the bond money, and the cap-and-trade dollars, we estimate about a $20 billion allocation of those funds, and that does provide sufficient funding, and I think the LAO said that, if you make those other assumptions, to San Jose, and it's about $30 billion to LA. So it's simple math. We simply didn't have $30 billion, we had $20 billion, and we could get this up and running now. I wouldn't call it an admission, sir, as much as just a recognition of the math.
How do you intend to finance closing that gap? How do you get south and pay for it?
There are a number of different strategies. Let me just first say, when I first got to the High-Speed Rail Authority Board, in our first draft business plan, 6 weeks after I got here, people had put in a whole bunch of different pots of money that could be there, and I didn't really find that credible. It was also my experience from 12 years on the BART board that these things are built in segments and dollars aren't always identifiable, in fact, rarely identifiable at the beginning. And so we took a very constrained view to just talking about things that had some certainty to them. On the Senate side, on Monday, they asked us to come back in the final business plan and lay out different sources of money that could fill that gap. But for these purposes, sir, let me just say that our estimate is that the fully built-out system will generate about $20 billion of private sector concession funds. Now, not all of that will be associated with the first leg, but there will be pieces of that with the second leg. Secondly, we haven't even, what you'll see in the final business plan, based on the request from the Senate side, is we will discuss a range of potential sources of money that we really haven't delved into too much. For example, in Japan, 32% of the revenues that the private sector operator gets come from real estate development around the stations. There's new legislation from this legislature. There are other potential legislative vehicles that would allow us to harvest some of what we anticipate will be enormous development around these stations. So that's one source of money. Asset monetization. We're building 520-mile linear system. We already hear from people who want to have us lease our right-of-way for fiber optics. Further federal money, I think, could be there. But are there gaps? There are. I would just point out that the Bond Act never contemplated that this whole thing would be opened up at once. What it said was you can build it in usable segments. You have to show you have the money for each segment, and that's what we're doing. So, Assemblymember, I'm not going to pretend that we sit here today and know exactly how all the rest of this is going to be funded. That is a standard that we can't meet today. I don't think any transit agency could meet. But we have our arms around pretty big chunks of it, and we are confident that about 2/3 of it right now is identified from current or sources that are reasonably potential, and we're looking at those other sources, and we'll lay that out in further detail in the final plan.
We've heard a lot about securitization. That's a code word for debt, for borrowing. How much do you propose to borrow? What would the terms of that borrowing look like? And what kind of a payback structure? How far out does debt instruments that you may be considering go?
Well, of course, a lot of those questions will be determined by the market conditions at the time. But in the draft business plan, and I think Ms. Peters alluded to this before, there would be about $5.3 billion, I think we said, of $5.2 billion that would be proceeds from financing, and that would be tied to the longevity of the cap and trade program as a financing mechanism. We don't have to borrow. We can go pay as you go. And I think we talk about that in the draft plan. That just means it takes longer. And again, I think the question of debt always is balanced against the question of benefit. So we would make that decision in concert with the legislature because, as was pointed out, well, we would probably need, the market would probably require some specific legislative authorization. And so this body would have the opportunity to reflect on that balance. Yeah. And it's like anything else. You get the thing built faster, you get the benefits faster, the employment, the tax revenues, and you're carrying some debt. And so we would need to look at that. But we said we think the sensible approach is to go pay as you go up to some part in the middle of next decade and then finance the rest, and we think that's the best balance. But you and your colleagues will have a chance to reflect on that before we go forward.
Again, what I hear is that there is an anticipation that the people of California and the legislature would have to, in some way, act as a banker here.
No, a securitization, sir, means that what you're borrowing against is an anticipated revenue stream. So if that revenue stream were already created, then there's no further obligation. It's not a general obligation bond. it would be against those revenues. I'm somewhat familiar with securitizations. I've dealt with them in the past, and the bankers in those cases asked that the legislature make certain commitments that that revenue stream would be available, but not for a generalized impact on the public at large.
But again, the taxpayers would have to, through this legislature, would have to approve the debt and the stream of revenue. I mean, it's a debt instrument. It is a borrowing of a lot of money.
They would have already approved it, Assembly Member. What I'm saying is, if there's a stream of revenue that is in the cap and trade program, even if today, let's just talk about 2020, if what we wanted to do today was to say, well, we'd like to just get that lump of money right now, we would ask the legislature for authority, and actually you've already given it to us because in 862 it said we could finance off of the cap and trade revenues. We could go out to a private financing source or a public financing source and say, see this revenue stream? If you believe in this revenue stream, we'd like to borrow against it now. There'd be no impact on the public. It's already a revenue stream in existence.
I took the opportunity to look through the 38-page response by Barclays Bank to you. It raises all of the similar kinds of uncertainties and concern that the LAO raises, and essentially, if you read through it, it just says that there are so many contingencies, so many uncertainties. So I guess I'm just saying my level of confidence certainly is not at your level of confidence with respect. There's a suggestion, I think, in the plan that part of the second phase or the completion financing would come through profits in the first segment?
That's right.
You are suggesting that the route between San Jose and Shafter will produce
positive operating cash
profits.
Right. Profits is
as is normally and understandable in terms of profits after all expenses.
That is correct.
Okay. There is, we tried to look, do you know of any high-speed rail operations in the world that make substantial profit?
Actually, all of them, virtually all of them, make an operating profit, which means that once the capital is expended, that they operate without any further subsidy and they throw off excess cash. A couple of them actually throw off enough excess cash to pay back some of their capital cost. We're not suggesting, although we kind of think we might get there, but we're not suggesting that's the case. Because of that fact, sir, that is why the authors of the Bond Act put in the requirement that there would be no operating subsidy, because they didn't think there needed to be, because they looked at the experience around the world. And I would also, finally, on this point, just observe, the closest thing we have to high-speed rail in the United States right now is the Acela service between Washington and Boston. That service, on its best day, maybe gets to 135 miles an hour. The track is terrible. They need to upgrade it. That service throws off excess cash that subsidizes other Amtrak operations. That's the closest thing we have today. It is not a true high-speed rail system. But around the world, once the capital is expended, these systems generate positive operating cash flows. And our business plan lays out the operating costs and the revenues and shows that there is positive net revenue, what you would call profit, even from this segment. That's why we're saying we can build it.
Yeah. The best I could find was Osaka and Tokyo, and they, I guess, break even through a little bit of what you define as profit. And I think the other one is the one from Paris to Lyon. But I do think it is a stretch to suggest that this segment's going to throw off profit. One final, I know that we're getting concerned about time. Your plan says that a round-trip ticket from Fresno to Silicon Valley is going to be about $126. It's $63 one way. The suggestion that we're going to load that train up with people who are going to go to Silicon Valley 5 days a week to work My calculator said that's $32,760. I'm not convinced that's I mean, how deep are you going to have to subsidize a ticket to make it reasonably and affordable for people who are trying to buy an inexpensive home in the valley and get to a high-paying job in Northern California at $32,000 a year?
Well, there's 2 points on this. First of all, the ridership and revenue model is based on sort of average numbers. A private sector operator will come in and do the same thing that they do with airlines, which is they will bring their own revenue optimization to this, which means that some people will be able to get discounted tickets for advanced purchases, for block purchases, for things like that. And so the actual cost for people will depend on the conditions in the private sector operator trying to make a profit at that point. The other thing is, we were just down in Silicon Valley. They made it very clear to us that a number of those companies provide transit support today for their workers. This would, I think, be something that we would anticipate to see. It would not be a subsidy from us, but it's not to say that the private sector couldn't help subsidize, as they do today, some of their workers to make those economics work.
I appreciate the time. I remain unconvinced, but I appreciate your answer.
We have you in the potential supporter column, essentially. Thank you, sir.